Well, good afternoon, everybody, and welcome to our third class in the Successful Investing 4 series, fondly known as the COVID Cancellation Conference. This class is called Profiting from Small Companies, and it features myself. This is Ken Kavula from the Mid-Michigan chapter, and Mark Robertson from Manifest Investing. And we're pictured in front of Tequamanon Falls in our Upper Peninsula gear. And munching on apple fritters, I've been told. So we'll have to get up there and give that a try in the next 6 months or so.
Well, yeah.
How about we do our disclaimer really quickly? We are going to be talking about a lot of real stocks in real time. And please, folks, we're not making any recommendations to buy, sell, or hold any of those stocks. We ask that you do your own homework. Our hope is to give you ideas that you can then research yourself and draw your own conclusions about whether you want to put them into your portfolio or, for that matter, take them out of your portfolio. If you got a reminder about this session, then you're probably already on our guest list. But if you didn't get a personal reminder about this session, and learned about it in some other ways and would like to be on the Mid-Michigan guest list, send an email to my wife, nkavula1@comcast.net. She'll put you on the guest list, and then you'll be informed on a monthly basis about whatever's going on in Mid-Michigan. We try to run 1 or 2 programs every single month. They're absolutely free, and we'd like as many of you to attend as we can possibly get. So nkavula1@comcast.net if you don't think you're on the guest list already. Those of you that want copies of the slides from this class we're going to be doing, send an email at the end of the session to markr@manifestinvesting.com. That's markr@manifestinvesting.com. And if you have questions about anything Mark has said, or for that matter, anything that I've said, we're both really active with our email, and we'd be glad to engage in a discussion with you about the topics that we talk about today. That's my email right beneath Mark's at the bottom of the slide, kkabula1@comcast.net. Our slides, folks, have a lot on them, and many times the purpose of the slide is not for you to read all the names, but it's to get a rough idea of what it is that we're discussing and talking about. We can then urge you to go yourself to the site where you can get a much better view of what's going on. And many of the things that we're going to talk about change on a daily basis because they're based in price and they're based in what people believe. So it does help to look at these things every couple of weeks to see what's popped up and what's new. That's where we're headed. So let's talk about small companies, Mark.
Well, Ken, I actually have a question.
Okay.
Why don't you and I go ice fishing together more often?
I think I told you this morning, Mark, I can't imagine an activity that's supposed to be recreational that I find more puzzling than ice fishing.
I'll bring the fritters. You said you wanted a good bagel. I mean, we find a good place to chop a hole in the ice, and we make the most of it.
Why don't we eat apple fritters and bagels in your basement instead of in a shack sitting on a piece of ice with a string in the water, okay?
All right, well, that's a segue, to I'm going to talk a little bit about ice fishing and small company investing and how they're the same thing. And maybe Ken will want to go then. I don't know. And then we're also going to talk about browning your portfolio before baking, and kind of a fascinating look at some people who really seem to know what they're doing. We're going to take a look at 7 years of actual selections and how they've done. And again, we're trying to kind of step back from the trees and see what we can learn from it. And we will be learning along and taking you along with us as we scratch our heads, at least our cyber heads collectively here today. We will touch on our selections for 2022. But as Ken said, we're not going to go over all of them. We're just going to hit some of the highlights, some of the selections that perhaps Ken and I have the most conviction about. and basically refer you to the active listing. And then we may have a little time for Q&A at the end. There is not a session after this one until this evening at 8 p.m. So we've got that advantage. Anything you want to add to that?
Mark, I have a lot of hands in the air, and what I'm going to do is take all those hands down. If you really do want to ask a question at this point, now's the time to press your hand icon or use the questions box and talk to me in text. But I know that that hand icon is kind of confusing. So if you look at it right now, there are no hands raised. So the way the icon is appearing right now, that's a down hand. If you want to raise your hand, press it once. There we go. We're getting, whoops, Mickey was just trying it, okay? And we're getting a couple of hands raised. Oh, we got 3 hands raised. So let's talk to these people real quickly. We're not going to do this during the session, but before we start, let's see what David Seaman has to talk about.
Well,
Dave, you're self-muted, so you'll have to unmute on your side.
And there may be some.
I think we're getting an inadvertent hand.
Yeah.
Al Young. Al, you're unmuted. Go ahead with your question.
How do inflation and higher interest rates affect small company performance?
An interesting question. In fact, I was just looking over a collection of inflation topics and stuff that we want to talk about during an upcoming bull session. We do bull sessions it's probably too much of a discussion right now, but we're actually going to tackle that subject of how inflation affects not just small company investing, but all of investing at a future bull session within the next week or two.
We could probably take hands for the next 20 minutes. I'm going to take 2 more hands and then we're going to get started, okay? Ernie Felzani. Ernie, you're unmuted, but you're also self-muted. So you'll have to unmute yourself to speak, Ernie.
Always good to hear from Boston.
And again, maybe an inadvertent hand because Ernie is not unmuting. So I'm going to take the hand down and let's get started on the presentation. Al, we haven't forgotten about your question. I'm sure that Mark will put it into the pile for bull sessions, and I'll try to alert you at the bull session that we're going to talk about it, okay?
Fantastic.
Go on, Mark.
All right. Well, let's roll for a few minutes here. All right, we kind of covered this one a little bit yesterday, and this is one of the most powerful themes that I can think of that justifies small company investing. And you've seen versions of this chart many times over from us. We do believe in investing in large companies, medium companies, and smaller, faster growing companies. And that blend is fairly important. It's basically the mix that you want in your portfolio. So you always got to be out there pursuing the faster growing companies because they either become medium-sized companies or sometimes they disappear. And either one of them leaves you in a constant need. I will tell you that I'm told that George Nicholson attended many Mutual Club of Detroit meetings, and the first thing he would say when he walked through the door is, what small companies are we unearthing tonight? So he constantly pushing to, discovering that next exciting investment opportunity. And we kind of covered this yesterday, but again, it really underscores the importance of, if you talk about the S&P 500, first of all, there's that flat decade that everybody knows about, but the S&P 500 is predominantly large mega cap companies growing at, roughly 5%, that lower rate, and they've returned 7.6% over the last 20 years. The value line arithmetic average, which is the 1,700 companies in the standard edition, again, growing at an average or median type rate of 9 or 10%, they've returned 11.1%. And that's what we recognize as the power of being properly diversified in all of the above investing. And I just love this quote that we just kind of touched on a little bit yesterday. I don't know if it rocked you as much as me, Ken, but that's pretty powerful stuff in terms of a justification.
Yeah, I've kind of been operating that way in portfolio management now, Mark, for years. equating the sales growth of my portfolio to the general place where the overall return is going to move to. Now, of course, that doesn't include dividends, and if you have a lot of dividend payers, then it might boost you an extra 0.5%, something like that. But for the most part, your sales growth over the long term begins to be very close to your long-term price appreciation, and that's a good reason, in my mind, for keeping the sales growth, the aggregate sales growth of my portfolio at a fairly high rate. I try to keep mine around 12.5%, and if I can do that, reminding myself that those are all estimates going forward, and depending on how good I am at estimate tells me how good I am at coming up with that number. But if I can keep it up around 12.5%, then usually the dividends and PE expansion kind of round out the package and allow me to move to that 15%, which in a normal year will beat the market by about 5 points.
Yeah, and certainly over the long term, the average. Well, there's Doug and Bob at the bottom of this page. I just thought we would acknowledge the fact that we check a bunch of sources, trying to uncover enough hay to find enough needles to be interesting and perhaps make a difference in our results. Today, we're going to be focusing in on this yellow box up at the top with the fools, and Kathy Wood is the lady in the center of the screen, and that's Chris Jenner on the right, and basically just talking about looking over the shoulders of people who seem to know what they're doing. Ken, do you have a favorite place that you like to discover ideas?
I really do like to look over the shoulders, Mark, and I really do have a half dozen, maybe 10 mutual funds that I kind of watch for what they're buying and what they're selling. But I also like to use the preset screen from the SSG Plus, the preset small company screen in the SSG Plus. And the reason that I like to use that screen is that better investing is using Morningstar data. And so when we end up with a new company just fresh on the scene that Morningstar is covering, if it's a high quality small company, then there's a chance it's going to appear on that very high quality small company preset screen. And when I'm running these screens, you only get 20, 22 companies on a normal week when you run it. And if I find 1 or 2 new ideas every couple of weeks, that's a lot. But it does keep me even, I feel, with the new stuff that's coming out there, and forces me to learn about things that maybe I wouldn't actually be that interested in. I know it pushed me real hard into fintech, financial technology, and all of the different ways that banks and finance companies and credit card companies and payment companies, all of the different ways that they're being stretched and turned end over end with the new technology that's out there, and finding new companies that are offering that new technology. And that's true in a number of different areas. Biotech's another area where I would never be able to stay up with some of these names if I didn't have a source for new things that were coming onto the market. So looking over the shoulders of the experts, and then this one preset screen, and you know how much I love the lists that come out once a year.
The fortune.
So you put that together. Yeah, you put that together, and you get yourself enough ideas to waste all kinds of hours during the day, Mark. All right.
Yeah, we are discovering that keeping the fund stuff, or in fact, we're going to be working on the fund FUND stuff at Manifest here shortly, and keeping that stuff, that's going to be a steady flow of ideas. It's going to be a lot of fun. All right, Ken, here's our ice fishing slide, and it's my theory. It's just something we noticed a little while back that the January effect, which is something we have talked about for many years. George Nicholson used to write a column every year for Better Investing, usually appearing in December, if not November, where he would encourage our community of investors to get out there and look for smaller companies whose stock prices had been punished by tax-related selling, selling for capital losses and all that kind of stuff. So the small companies would get hammered it actually was in December, many times between Christmas and New Year's Day. And then come January, you could buy back into these companies and then get this boost of this demand of people kind of rebuilding their positions. We have contended for quite some time that date has shifted, and it at first it shifted back closer to Thanksgiving. I now believe it's probably closer to Halloween. And what you're looking at here is the 20 companies that we chose for 2022 in a tracking portfolio. If this is a what if you went back to what they were a year ago, Halloween a year ago, I would contend that you're basically looking at a January effect starting around Halloween. And it's an interesting time of the year to be buying good, promising small companies. Anything you want to add to that, Ken?
Well, I know that there's people out in the audience right now that are going to go searching real quickly for a counterexample. And all I have to say is that the counterexamples, if you don't have too many of them, only prove the rule of what normally happens. This January effect I've been aware of now since I began investing in the late 80s. Since I do a lot of that thing myself, I do tax sell and I hold it until later in December. In fact, I'm doing active selling, Mark, between Christmas and New Year's a lot of times. But I also have seen clubs that I belong to begin that evaluation process and then begin that selling process as early as the November meeting. And for a lot of those clubs, that's the first or second week in November. So yeah, I think it's a real thing, and I don't think it's going to go away as long as our tax laws are written the way they're written.
Yep, and yeah, I'm in agreement. You can talk sample size, you can talk anything you want. There is something out there, a phenomenon that's again, no guarantees there aren't any in this business. But here's what Ken was referring to. Some of the funds that he's talking about are probably on this list. These are the 20 best performing funds that we track, and we track about 800 funds right now. Exchange traded funds and mutual funds. And this is a list of the best performing by terms of relative return over the trailing 10 years. And you'll recognize many of the names. The ones that have an M in front of them are a traditional mutual fund. If they don't have an M in front of them, they're an exchange traded fund or perhaps a closed end fund, but an exchange traded fund in most cases. So from top to bottom, you see the top 20 there. And you can see their long-term returns in this column, the annualized total returns, compared versus the market over the time, whatever time frame is involved here. Some of them are not 10 years. Here you see Kathy Wood at ARC is only since 2014. Here's a relatively new fund that's 1.4 years old, Fidelity Blue Chip Growth, although it's an outgrowth of this parent. So you can see from top to bottom. So what you're looking at is a list of funds who have demonstrated an ability to identify opportunity, particularly among smaller or faster growing companies. And we like to draw people's attention to the fact that you have this really nice column over here, and right side by side with it, here is the sales growth forecast, the actual average sales growth forecast for the portfolios from top to bottom. And note the double digit characteristic here. So I think this basically says George was right. Put enough growth in your portfolio if you want to have a chance of experiencing something like this list of companies. The Institute.
Yeah,
Go ahead, Ken.
I tend to creep around some of these select funds, Mark, when I'm looking for a tech stock, for example, or tech ideas. Fidelity Select Technology, and there's a couple of other companies that have select funds as well, will many times give me ideas about smaller companies that I never even heard of before. because the fund is focused on that particular sector, and the people that are running these select funds are firm believers, or at least I think they are, in all of the above investing, where they're not only looking for the giants in the sector, but they're looking for medium-sized companies and small companies to invest in. So I really like those kind of things when I'm kind of zeroing in on a particular sector or even a particular industry. But I have to tell you that Brown Small Company is one of the 3 or 4 that I always check and I always look at. And the ideas that come from Brown, you can count on 1 or 2 good ideas on almost a monthly basis.
Yeah, and we're going to look at that one in greater detail. By the way, this is a rather weak performing fund over the last year to 18 months. They used to be in the top 20. Notice that they are now down here, which is, it's not the end of the world, but they have lost a few percentage points over the last, well, it's actually going on 2 years now, 18 months or 2 years. And Ken, would you like to take a guess what sector they don't invest in at all? You probably know the answer to that.
Oh, I should know the answer to this, but Mark, I can't put my finger on it right now. No.
They invest in no financial sector companies.
Financial sector, of course.
And of course, I mean, look how well the financial sector's done in the last 18 months to 2 years, and they have sat that out. And just kind of an interesting thing. They make a conscious decision to avoid the financial sector.
I want to draw to our audience's attention, because a lot of you aren't used to reading a chart where the final column is relative return. And I want you to think about what relative return really means. It's not the return coming from the mutual fund. It's the amount of return that is beating the market from the mutual fund. So you have to back up to the annualized total return to see the total, and then you subtract what the market has done. That's the second last column, and that gives you the relative return. These funds that have relative returns in the 6, 7, 8% range are extraordinary funds. They're doing extremely well. Think about your portfolio beating the market on a regular basis by 6, 7, or 8 points, and you begin to see how extraordinary their performance actually is. Brown, even at a 1.7% relative return, is still nothing to sneeze at. It's still beating the total stock market by almost 2 points, and that is statistically significant. So make sure you're reading the chart correctly before you draw conclusions.
Yeah, and the other thing I would point out is as you look down that quality field, that's our quality rank, and there's obviously a bunch of different styles here. You know, ARC Innovation is known for their disruptive innovation and early stage investing, down to, you know, a Motley Fool 100, I would say invests like we do. A lot of higher quality companies in it. And that Vanguard technology is just chock full of Apples, Microsofts, you know, et cetera. You know, companies are in that. So just be aware, there's some different styles involved here, and some of them are micro cap or very early stage is the differentiation. Here's when Ken is talking about sniffing around these funds. This is an example from a couple years ago, Brown Small Company. And note that it's not small cap, it's small company. They're the only fund that I'm aware of that actually gets it right. Brown Small Company, and as you look down that list from top to bottom, again, this is where we watch for these opportunities. Companies that kind of leap off the page at us. But what I want you to notice is some of those dates, going all the way back now 30 years in some cases. And a lot of regular household names in here. Very, very much community favorites.
People might ask what would draw my attention, or what would draw the attention of somebody looking for ideas. And for my purposes, I would look at this chart, which is readily available in Morningstar, only it's updated. This is a Morningstar chart, correct, Mark?
Yes.
Yeah. It's readily available, and I would just glance down that column looking for holdings that Brown has either put new into the portfolio or has raised a significant amount. So a Biomed up 21% in the portfolio amount in the portfolio, and Glaukos up 81%. Rhythm Technologies up 65% almost. Those would be the kind of stocks that would draw my attention. And am I going to agree that all of those are screaming buys and I should plunk my money down? Absolutely not. When I'm looking at these kind of lists, I'm doing it in a very low tech way. I'm keeping a list off to the side, and these are just ideas that I'm going to use as springboards going forward. I really insist on small companies, at least for my core holdings. I insist on small companies that perform just like my large companies. Why not ask for the very best? Why not have some history and some consistent earnings? Why not have companies that show the same characteristics as your large companies that you're in love with show? So up, straight, and parallel is not impossible to find with small companies. And here's a way to come up with an ideas list. I also like to look at the ones where they've been doing a lot of selling. Metadata, for example, back in 2019, when this chart is dated, was under some selling pressure. If I owned that stock, I'd want to ask myself the question, why is Brown deciding that this one belongs at a lowered place in its portfolio as far as number of shares, you know?
I just find it fascinating that Neogen, which was a relatively unknown company back in that time frame, 2007, it could have brought it to your attention. So again, this notion of browning your portfolio with a successful, looking over the shoulders of a successful company, this is a look back at in that same time frame. I discovered that if you had just invested $100 into these when they came on to the lists over a period of a number of years, your annualized rate of return would be 18.1. By the way, that matches up exactly with where they're at today. But your $2,400 would be worth almost $26,000. And their turnover is low. They think like we do. They hold on to them for, again, the average holding period is 9 years. And these words are very important to us. They're serious about this. They are selective. They think like we do. And then two of Ken's favorites, patience and discipline. So watching for when these companies come on the list can be an important source of ideas. I think we're going to come back to Brown a little bit later. And
the only thing wrong with Brown, Mark, is that it's closed to new investors right now.
Exactly. It's one of the reasons that people track the stuff that we do, Ken.
Yep.
All right. So let's go ahead and talk about this one now, Ken. Would you like to set the table for best small companies?
Well, I like lists, and I get all kinds of magazines. My coffee table is stacked with magazines and everything, and I've been a subscriber to Fortune and to Forbes probably for 30 or more years. I know that's a dinosaur habit, but this dinosaur likes his magazines. I like to feel the pages under my fingers and everything else. And when these lists come out, I pore over these lists. I put them onto spreadsheets. I put them into manifest investing dashboards. I'm looking to check them against what I own and what I'd like to own. And since the turn of the century, we've been kind of tracking these small company lists that Forbes especially has been putting out right around Halloween. And in 2006, we decided that the Forbes lists were a little bit longer than we'd like to focus on. The Forbes list at that point was 200 companies. They would call it the best 100 small companies and then the next 100 best companies. Well, we thought that maybe if we could narrow that down to 40 or 50, we would maybe be able to do better than the list as a whole and as the market as a whole. So in 2006, we started choosing a subset of the Forbes list. And from 2006 to 2014, that's what those blue bars and red bars are measuring. They're measuring our subset that we call the best small companies taken from Forbes list, and we measured it against the Wilshire 5000. You all know what happened in 2008. It was hard for anybody to make money in anything, but absent that particular year, you'll notice that in most of those years, the best small companies that we chose as a subset were able to do better. Even in 2008, we lost less money than the Wilshire lost with our choices. There were a couple of years that were kind of tough. 2012 especially was a real tough year. And in 2014, the Wilshire smacked us on the bottom again pretty hard. And then to add insult to injury, after that list in 2014 came out, Forbes said it wasn't going to publish these lists anymore. Well, we didn't want it to die, so Mark and I decided, well, let's just create our own list. We'll use the criteria that Forbes used. We'll feel free to adjust that criteria and add to it, but we'll be real open and talk about what the standards are to be on the list in the first place. So in 2015, we created our first list. I think that it had 30 or 40 or maybe even 50 companies on it. And as we've gone and moved towards 2021, the number of companies on our list has reduced itself because I think we've been asking for more and more stringent things to happen in order to make the list. Is that a fair statement, Mark?
Yeah, I think it is, and we're going to actually take a look at the list. We'll just briefly run through them, but you're right. We started with 40 or 50, and now or maybe we're pretending to be more focused, but we're certainly doing that. Here's that 2015.
I just want to make the one point before you get off that slide, Mark, that since we've been doing this, that red bar is bigger than that blue bar for 7 years now. And that's all I'll say because I don't want to jinx the 2022 year, you know. I said it before you had to say it, Mark.
We're doomed.
All right.
We're doomed. We're actually ahead by 3 or 4% this year already, but no. We don't want to talk about that. All right. Here's the best small companies that were on that 2015 list. Again, some pretty interesting names. You guys will remember a lot of these. Remember BioReference Labs? This is one of the better years in the history of us doing this, beating the market by almost 15 percentage points. And Mesa Labs, BioReference Labs, a lot of those type of companies, Mesa, showing up on the list. And again, what we began emphasizing, very consistent with and in keeping with the Modern Investment Club principles and philosophy, we wanted to find companies that were basically up straight and parallel, even though they were small, promising, exciting opportunities. So we began doing that. First year went pretty well. Second year went even better. This is what Ken was just referring to. We used to take and make a much larger list, and then we began whittling out some of the lower return forecasts and attempting to do better, but this list did pretty well. So 2016 and 2015 were pretty good years in the history of this effort.
What I find so amazing, Mark, is that when you look at these lists and you look at, or I look at portfolios that I'm managing today, I'm struck by how many of the names from this list are in current club portfolios that I help manage and in my personal portfolio that I help manage. Mm-hmm. I work very closely with my sister to help manage some portfolios that she has, and I sometimes wonder if she wants to think, where the heck did he come up with that name? Well, a lot of times the genesis of the name popping into my head is coming right from these lists that we pull together about the best small companies. I challenge any of you to read down this list of 50 companies and not find at least 2 or 3 that you own if you're a better investing investor, because we've made them popular in our community, and they've proven their worth by their performance. So an arrow should definitely go on credit acceptance there, Mark. That's been one heck of a number 30, right?
Yeah.
One heck of a ride on that particular
I
stock.
had
Yeah.
I hadn't noticed that. Well, Five Below's on here, which is cool. That's
Yep.
big
Yeah.
for many of us. Gentherm is on this year's list, and I
Well,
can't tell
and
it's
also
this one.
at number 44, EPAM, which
Yes,
is
yes, yes.
fighting. It's fighting right now for the top spot in the roundtable portfolio, I think.
It is.
It's challenging Microsoft for the top spot in the roundtable portfolio. We don't guarantee that all these companies still exist. One of the nice things about small companies is that sometimes a big company notices how well it's doing and chooses to swallow it up. Now, that some people think that's negative. From my point of view, you usually make a nice tidy profit when that happens, and you say thank you very much, and you move on and you look for the next small company, the next small opportunity.
And I guess one other thing I would point out, as we've done these lists over the years, at number 4, Popeyes, Louisiana. That's one that I was extremely uncomfortable with at least one year, if not multiple years. And that was a number 1 stock in one of those years in terms of the performance.
Mark and I both have a little bit of a bias against restaurant stocks, and yet we've had a couple of restaurant stocks do extraordinarily well in these small company lists. Extraordinarily well.
All right, let's keep rolling. 2017, again, a similar list. You see many companies repeating on here. Again, a very strong performance, beating the market by 8 percentage points. There's a number of companies on this list that are on this year's list. So they've established themselves, and they've been moving right along.
Well, I think, Mark, that this list marks the emergence of aligned technology to the collective conscience of the better investing community. Number 12.
Yeah.
And look what the price was for aligned technology back then. I mean, we're coming up with these ideas and we're putting them out there. We're showing you companies with really nice charts attached to them, really good, strong, consistent growth in sales and earnings. And then we're suggesting nobody really knows very much about them right now. Why not take a little bit of a jump at them and see what's going to happen with some of your small company investing? There's again a nice collection on this list of companies that I would wager that a lot of you own in your own personal portfolios.
Yeah, notice Universal Display on here, right about the same time it came to the roundtable.
Yep.
All right, here's 2018. We still were not winnowing down the list, and we were winnowing it down. We were whittling it down, demanding a higher return forecast. But again, from top to bottom, a number of pretty prominent names within the community. Some of those companies have been very good to us, and some of them exist to this day. By the way, Forward Air's been on every single one of these until it got too big. And then,
I also think this is the first time, Mark, that we allowed a bank to sneak onto the list. At number 15, we allowed Signature Bank to sneak in here.
and it did well.
Yep, it did quite well. But one of the rules from Forbes had been that they were not going to allow any asset-based companies on their lists. That was banks, insurance companies, brokerage firms, things like that. And we tipped our toe in the water in 2018 by allowing a bank. And you'll notice that that bias has weakened considerably as the time has gone by about whether or not you can make money from asset-based companies.
Absolutely. All right, 2019, getting closer to more recent memories, here we did take it down to 20. I don't know if we were forced to, if we wanted to, but again, sticking with very high quality, good companies or excellent companies, and also demanding a double-digit return forecast in addition to double-digit growth. And EPAM was just off and running by that point in time, along with IPG, which is another roundtable favorite, Align Technology. Simulations Plus has been magnificent for this effort. And
Yeah, what's really appealing, Mark, is that you put a company like Align Technology up there, and then you smack a projected annual return of plus 20% on it. And a lot of people say that can't possibly happen. And yet you look back on this particular company, and for 2 years running, it was the best performing stock in the S&P. The best performing stock, and it was doing a lot better than 20% annualized return at that point.
it's actually been a while since I tiptoed through the historical lists. I'm having a lot of fun. I hope you guys are too. Here's 2 years ago, and these companies are more current and more in our consciousness, at least as newcomers. And some of these are definitely repeating this year. I can remember being nauseous about Wingstop and Shake Shack being in the portfolio together. And Wingstop finished in the top 3, I believe, and Shake Shack didn't do too badly. Yeah. How about Biospecifics Technology erupting off the list? They've since been acquired.
That was one of those too good to stay small, and some big guy decided they were going to put their mark on that company, so they bought it up. But they bought it up at a premium, so you made good money even though it was acquired.
Yep, and Kim Butcher brought biotelemetry to the roundtable. That was seconded by Chris Jenner at Rock Springs Capital. So again, this one worked out pretty well too. Hope we're not jinxing ourselves, Ken, but all right. And so in the most recent year, this was what we started with a year ago. Pretty good list. Have to honor the emergence of the banks. And again, we didn't force it. They just showed up, some of them firing on all cylinders and doing pretty well. We're pretty glad that Western Alliance joined the party. But from top to bottom, again, a pretty good list of companies that have been fairly high on the radar screen for many of us within this community.
Yeah, I had been a shareholder in Bank of the Internet and was really tentative about Axos Financial. That's the successor company to Bank of the Internet, same company, different name. That's a completely internet-based bank with no branches anywhere, but I'll tell you, it's performed at an extremely high level. I own it personally, and I know of a couple of clubs that I belong to that own it as well. This marks the emergence of a couple of home builders on the list as well, Mark. I see MI Homes and I see LGIH on the list.
Yeah, and LGIH has done quite well in a number of our portfolios. So good stuff. So this was, by the way, the closest finish in the last 7 years to the Wilshire 5000. And in fact, it dipped down to within 1.9%. And not like I watched this very closely. Around lunchtime on Wednesday before the year ended. We went from being 10 percentage points ahead to 1.9 at lunchtime on Wednesday. So cost me a fingernail or two. Here's the actual contributions to performance, the actual results for the last year's selections. And again, we are pretty grateful. Those banks are up there at the top and financial institutions.
Those two in yellow background, biotelemetry went away. It doesn't exist anymore. And Global Cord Blood, that's a Chinese company, and we could not decipher what Cord Blood was trying to do with itself and what all the press releases meant. And we finally decided just to move it out of the portfolio. There was some very, very odd things going on with Global Cord Blood.
Yeah, it was a private equity transaction that happened around that time frame. So thank you, Western Alliance. And just to drive the point home, the average quality rating of the companies in last year's list was 72. Again, that's not bad. It's pretty good balance, a pretty high component of up, straight, and parallel.
Well, and we make this point about home runs all the time too, Mark. The return from Western Alliance, just from that one home run, balances out the complete set of losses of the bottom companies, so that you don't have to hit a whole lot of home runs to really keep your portfolio moving in a positive direction. That one stock balances out the whole bottom. Really, really impressive.
Yep, nice offset. So just for kicks, I had never done this before. I kind of stepped back. I was going to do a really deep statistical analysis, and then I kind of thought to myself, well, first of all, Mark, you're lazy, and you really don't want to work that hard. Second of all, let's keep it simple. And what we did is went back and looked at the 7 years that Ken and I have been doing this, in addition to the last year with Forbes, and just calculated the average sales growth forecast for those collections of companies. And then the actual result is in display on the far right. And again, scratching our heads over the internet, I find it interesting that some of the highest growth forecasts align, again, very small sample size, I get that, but the lowest returns align with the highest growth forecasts. To me, that would suggest, and I think it's somewhat intuitive, when you start swinging for the fences and closing your eyes and swinging harder, you start getting into trouble. And so
you whiff a number of times, right?
Yeah, so there's got to be something comparable to a sweet spot, and it sure looks like it's in that 14 to 16 range, just in this small cursory snapshot.
I'd be willing to bet that George Nicholson, when he was talking about aiming your portfolio at somewhere around 13.5%, was probably closer to being extremely accurate than we were in moving up to 18 and 19%.
Yeah, and I'm not so sure with the small, medium, and large that we aren't looking at like a 5, 10, and 15, plus or minus on each one of those.
Yeah.
Something that we can dig into in greater detail. But again, from a very simplistic point, yeah, is it possible to swing too hard for the fences? I think so. This is in here just to remind you what some of the rules are. Double-digit growth, greater than 12%. We're a little bit fussy about revenues. Don't want to have anything too big when it comes to annual revenues, but there is some latitude. We don't like them to get too small, but you could have an exception, especially for a company in your backyard that you really can almost establish a relationship with. No penny stocks. We do let the banks and insurance companies in when it makes sense, and we just think it's a good idea to go shopping, not just for growth, but for return and quality also. Up, straight, and parallel is possible with these types of companies. All right. Quick commercial for bull sessions. We've been talking a lot about how this stuff is not just theory. This is a busy chart with Amazon. We'll talk about it in greater detail. We actually have Microsoft and Under Armour, probably Tesla, that we'll be taking a look at in this type of detail. You can actually do analysis of opportunities earlier in their stage, their life cycle stages, and that's what we'll be talking about. So here's this year's list so far, Ken, sorted from top to bottom from return forecast as of today. And your Southern Missouri Bancorp is still hitting it out of the park.
We started with $100 in each one of these on this dashboard, folks. So if you look at the value column, you'll see that those companies that are losing in absolute dollars and those companies that are winning in absolute dollars. What's the market up right now? About 2%, Mark?
No, something like
that. A little bit less. A little bit less.
Actually 1.1% to be precise.
Okay, so CarGurus is up 13.33%, and you subtract the 1.1 that the market is up, so it gives you a relative return of about 12%. You can do some simple arithmetic in your head. That cash there is coming from, we're going to do some active management in this portfolio. because this particular dashboard is going to represent pieces of our pie on, forgive me, Mark, I forgot the name of the broker. M1, is that correct? M1 Financial, And the active management right now led us to remove emergent biosciences from the portfolio.
eHealth.
I'm sorry, I Freudian slip. eHealth from the portfolio, and eHealth had dwindled from its original 100 down to $67.58. At Tuesday's bull session, we're going to reinvest this in one of our companies that was kind of on the 21, 22, 23 spot on our rankings, and we'll try to get a new company added to this actively managed list. Don't hesitate to think that we're going to leave the passive list. We are going to still keep the passive list there so you can see how we did compared to all the other years at the end of this year. But this active managed list is a little bit of a twist that we're going to give a try to as well.
Absolutely. So what we thought we'd do is just go through, we're not going to go through all 20, but present some of the highlights of this list. And so, Ken, go ahead and drool over your Southern Missouri Bancorp. By the way, this is up 50% since we first noticed it in early October?
Yeah, when we first started doing our final lists, from that point to now, it's up big time. It's up pretty nicely even since the November 1st start of this measure. This is a really small bank, oddly enough, in southern Missouri. And I'm just going to point out the percent returned on average assets. That's down near the bottom of the slide, the fourth line in the evaluate management section. Just for comparison's sake, 0.85 is a wonderful, wonderful number to use as the average return on average assets for a typical regional bank. When you move that up to 1.25, you're looking at a pretty decent bank. And when you move that return up to 1.5, you're looking at a darn good bank. Well, you can see in the most recent year that this number has moved for Southern Missouri to 1.79. Now, if it can maintain a number in that 1.5, 1.6, 1.7, 1.8 range for the next couple of years, this will have cemented its place as one of the truly outstanding regional banks in the country. We put it on the list because it appears to be just at the beginning of its really highly excellent period. Mark put a yellow card on it when we put it on the list, just because it's currently, when we put it on the list, it was trading at its all-time high, and that all-time high has since gone higher as the bank has continued to trade itself higher.
So
we did remark, go on, Mark, say it.
Do I get to yellow card it again?
No, don't yellow card it again. But we did remark that all-time high was just coming back to numbers near where it had been in some of the other years.
Yeah.
So while it was a 52-week high and an all-time high, it wasn't outrageously high at this point.
No.
We'd love for it to be outrageously high by the end of the year. We'll have to hope and see. Yeah.
All right. Again, Ken and I are just giving you kind of the ones that we have the most conviction over. So our highest conviction among the 20, we thought we'd do a handful of them. This is Green Brick Partners. If you're not familiar, it's a home builder out of Dallas, a smart home builder, very selective home builder that is very carefully expanding with strategic partnerships. It is not a partnership in terms of structure as an investment. It is a stock, a regular stock. It is not a partnership, so you don't have to worry about that kind of stuff. I'm not going to beat it to death other than to say it's, and by almost any metric, it's among the leaders within this industry group. And Matt Spielman, who's in the audience, Matt covered it very well in our expected returns, which was last weekend. And if you want to listen to Matt's play-by-play on the company, you can get to the YouTube through that link at the bottom. And if you're a Manifest subscriber, the entire presentation is also available under that topic. I'm going to consider this to be in my Maslow portfolio, as roof over one's head is an important thing, and these guys are pretty good at it. So number one on the Maslow list, a place to have.
Some of you might be saying on that that slide, if gross margins for Greenback, and that bar is green right there, are really good, why didn't you pick LGIH? LGIH was not picked only because it had gotten bigger than our limits. It's up to about $4 billion in sales right now, and it just isn't large enough or small enough anymore to be on the best small companies list. We still really, really like LGIH as well.
It's been very good to us. All right, your second favorite, Ken.
I like Ensign Group. I like this whole concept of medical facilities, regional facilities, places where they do outpatient work. Ensign Group kind of distinguishes itself by having a lot of its facilities devoted to mental health, as well as the physical part of health, the surgery and the blood work and all that kind of stuff part of health. The mental part of health didn't suffer nearly as much closure during the COVID times. Those folks were able to continue their work remotely in many cases, where the physical places had to either reduce the amount of patient contact, or if it was elective kind of surgery or elective kind of operations, then they had to, they closed a lot of that down during COVID. I think it's the kind of up, straight, and parallel, long history company that if you didn't know this was a small company, you'd look at the graphs and you'd say to yourself, well, this is just like any other up, straight, and parallel that I invest in. I like the concept. I like what it's doing. Take a look at it, folks. It's interesting.
Yeah, and I'll dovetail on this one a little bit, or piggyback. That is Chris Jenner from Rock Springs Capital Management. And there's a number of these medical service facilities on his list of holdings, including number one, where he plopped down 5.6% of the hedge fund portfolio in a single transaction. You can follow them at insidermonkey.com. And Agilon, I think, would be a comparable company in terms of the strategy and services that they're attempting to provide. So I just think that this area is worth paying fairly close attention to. Somebody's eventually going to figure out how to make money at this, and these guys have been, and Chris is interested. Therefore, my ear is to the rail here also. Here's my second Maslow pick. I like electricity at my house. These guys put in wires and towers and stuff like that, along with some new energy stuff. MYR Group is basically a consulting / construction firm. And again, they make the electricity come to my house. This is also on my Maslow list of things that I think I need. Pretty good track record. Marie Frank likes it, and Marie is really good at picking stocks, and it was on both of the fastest growing lists fairly recently. A good study. Take a look at it. I think this one's yours, Ken. Gentherm.
I like Gentherm. I'm from Michigan. I like auto manufacturing, and I like secondary auto companies. I think Gentherm has a lot of the same kind of characteristics as a Zeeland, Michigan company called Gentex. Now, they don't compete with each other at all, but they're both into very high-tech add-ons to automobiles. Gentex makes high-performance mirrors and high-performance headlights that track the road. Gentherm is into really high-performance climate control based around the seat in your car. I would take a real serious look at this company. You can read press releases that talk about Gentherm getting a large contract from one of the world's largest electrical vehicle manufacturers to make seats going forward. The question will be, do they really mean it's Tesla, and how large is large?
It could be Rivian.
It could be Rivian. You just don't know. So I think this is raised on my radar. Gentherm has been off and on our lists for a long period of time.
Yes.
You see the growth characteristics that it had from 2011 through 2015, went through some tough times, and now it looks like it's rediscovered its mojo, and since 2017 seems to be moving again in the right direction with earnings. The sales up until 2020 had been on the slow decline. We'll have to see if some of these new contracts revive the sales, the top line in the company.
You know, this is such a far cry from my dad in the 1965 Buick. And you put down the windows. In fact, you had to roll them down by hand. Okay, whatever. All right, my last pick, and
didn't you ever sit five across in the front seat, Mark? Come on.
Oh, definitely, and no seat belts. All right, really busy slide, but all you need to know is beer. And I also classify this as another one of those Maslow need stocks, because cereal matters. Cereal matters in our lives. And Ken is sitting there silently chuckling because he knows I don't drink very often, but some people do. And you kind of cinched it with Doug and Bob McKenzie. They consume a lot of these type of products, but this is a company that just got hammered by an entire generation of citizens slowing down on drinking the truly hard seltzers. And it actually made quite a dent in the corporate strategy. They've been through this type of stuff before. I think they'll come back just fine. They've managed a pretty distributed product line. They do a lot of contract manufacturing for other companies. I happen to think that a stock price that's dropped from 700 down to 400 without something materially wrong with the business just reeks of a buying opportunity, potential opportunity for good
and Mark, we should mention that from our point of view, that a lot of this stuff about the hard seltzer was a little bit of a tempest in a teapot, because that hard seltzer represented less than 4% of their revenues. It was not a core revenue maker, and when it went down in sales, I think people just absolutely panicked. I don't think they stopped to ask themselves how much money is actually involved.
Yeah, so it's another case where let the actual business model pictures and your visual analysis guide you, and don't necessarily pay so much attention to what you're hearing. All right, and we got to have one more bank apparently.
Well, Mark said I could only pick three, and I didn't want to put two banks on a list of three, but I did tell him that I really liked Axos Financial at this particular time. Axos seems to have gotten its act together. In its early years as Bank of the Internet, it was offering house loans to people basically on their signature. It wasn't checking any income. It wasn't looking for down payment. It was doing some things that greatly contributed to the financial crisis. But in its reimagining as Axos Financial, it's acting as a very conservative regional Midwest bank, which essentially is what it is right now. And the only difference between it and the bank that you might use if you're in the Midwest is the fact that Axos doesn't have any branches, and everything is done completely over the internet. I find that a really interesting model. If they're successful with it, then it's sure to keep expenses down, which will allow the bottom line to grow. And if that bottom line grows, then return on average assets can start to approach that 1.6, 1.7, 1.8 number that we mentioned with Southern Missouri Bank, that would put this bank right in the same category of truly outstanding compared to its peers.
Good stuff. Well, I'm throwing a red card, just not because I want to veto Axos Bank, but we're running out of time, and at some point I have to cut you off with Vladimir's help. to keep talking about more banks.
Stoi.
And with that, again, I hope we've persuaded you to get out there and hunt down some of the best opportunities in small companies and enjoy an apple fritter and some ice fishing while you're at it, and have a great day out there. Any closing thoughts there, Ken?
No closing thoughts, but because we do have some hands in the air and some questions, we're going to stay on after we close the session down. So we're going to give us a chance to close the session, and then we will answer some questions and talk to those of you that have your hands raised.
Okay, thanks everybody. Good luck in your hunting, and please let us know when you discover an exciting, promising, I call them wonderkins, promising small companies. Let us know. Thank you.
I hope to see many of you at our Stock Pickers panel discussion this evening. Starts at 8 o'clock. We have 7 pretty good stock pickers on the panel, and we're going to give you some, we think, really intriguing, interesting ideas to maybe invest in. So for now, let's say see you tonight.
Okay.
Bye-bye, everybody.